These are the major tax changes in Canada for 2026. If you work in Canada and you feel like taxes, retirement rules, and saving limits keep changing on you, you're right. I'll show you what changed from 2025, how it affects your take-home pay and retirement planning, and how you can make practical moves to decrease your taxes and hopefully increase your net income. Number one, let's begin with everyone's favorite dinner table topic, federal tax brackets and the basic personal amount. The 2026 federal brackets are 14% on the first $58,523, 20.5% over $58,523 up to $117,045, 26% over $117,045 up to $181,440, 29% over $181,440 up to $258,482, 33% over $258,482. If you earned roughly $50,000 to $90,000 in 2025, these indexation changes will likely trim a small portion of your federal tax burden. But remember, provinces still levy their own tax rates. Number two, the BPA, or basic personal amount, the amount that you can earn before you pay any federal income tax. For 2026, this is $16,452, the maximum for most taxpayers. The BPA phases down at higher incomes. People earning above the top thresholds receive a reduced BPA. The BPA increase, coupled with the 14% lowest rate, provides modest relief for most taxpayers. Number three, the TFSA. Small name, but very powerful. The contribution limit for 2026 remains unchanged at $7,000, the same amount that it was in 2025. For people who are 18 years or older, have been Canadian residents since 2009, and have never contributed to their TFSA, the lifetime contribution TFSA room is $109,000. However, please always confirm your contribution room by going on to CRA My Account. One important note to remember that is often overlooked is withdrawn amounts only increase contribution room in the following calendar year, not immediately. Number four, the RRSP. The RRSP limit for 2026 is $33,810, an increase of $1,320 from 2025. Your personal RRSP room is still the lesser of 18% of your prior year earned income and this dollar limit, plus any carry forward room. RRSP contributions made in the first 60 days of 2026 can be applied to the 2025 tax year. The deadline for RRSP contributions to count for the 2025 tax year is March 2nd, 2026. In case you're new to my channel, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. I've been investing for just over 20 years now, and I have the experience to back up what I'm saying. If all of this sounds like something you'd be interested in, consider subscribing to my channel below. Number five, the FHSA, the First Home Savings Account. The contribution limit for 2026 is $8,000 and the lifetime cap is $40,000. Remember, carry forward room only starts to accumulate after you've opened your FHSA account. So if the RRSP and TFSA had a child, the FHSA would be that child. All the acronyms, huh? Because you get to make contributions to your FHSA account tax-free. They are not subject to tax when made, and when you withdraw those amounts, they are also not subject to tax or the gains that you've received from your investments. So it's the best of both worlds. However, when you withdraw those amounts, it must be for a house. Number six, CPP changes. What appears on your paycheck? Remember, the 5.95% CPP deduction you see on your paycheck applies to earnings up to the YMPE 74,600 for 2026. The CPP enhancement added a second higher income range. Income above the YMPE is charged an additional 4% for employees. The employer matches this amount. So the total contribution rates are 11.9% on the original earnings range and 8% on the new enhancement range. Self-employed people pay both shares, the full combined amounts, so contractors and freelancers should model the full impact on cash flow. Number 7, OAS, Old Age Security Clawback. Check the recovery period. The OAS recovery threshold is indexed and applies to specific payment windows, thresholds used for July to June periods. Because this number changes each year, don't rely on a single fixed figure in your planning.
The OAS recovery tax, often called the OAS clawback, can quietly reduce or eliminate OAS payments if a retiree's net world income passes the index threshold for the relevant payment window. Practically, that means the tax year you report, your prior year income, is used to decide OAS payments for the July to June period that follows. For example, your 2024 net world income was used to determine OAS payments paid July 2025 to June 2026. When income is above the threshold, the government recovers 15% of every dollar over the threshold. There are also upper thresholds at which the full OAS can be clawed back. So check which income year and July-June window matter for the payments you care about, run a quick projection, line 234 on your return, and model 15% times income minus threshold, so you know whether delaying OAS or taking extra pension income will trigger repayments. If you or a client are near the limit, simple steps such as timing RRSP withdrawals, splitting pension income, or deferring OAS can change whether you lose a chunk of benefits.
Number 8, Canada Child Benefit Updates, CCB. The Canada Child Benefits have been indexed for 2026 and have increased. Yay!
The CCB is indexed annually, and the amount you receive for each benefit year, which runs from July 1st to June 30th, is recalculated using your previous year's tax return. For the July 2025 to June 2026 benefit year, the top maximums were $7,997 per child under 6 and $6,748 per child aged 6 to 17. Those figures are indexed, and reporting shows the maximum CCB for the July 2026 to June 2027 year will rise further. For example, reported maximums of $8,157 for children under 6 and $6,883 for children 6 to 17. That means many families will see slightly larger monthly deposits starting July 1st, 2026, but the actual payment depends on your adjusted family net income and the CCB phase-out rules. Bottom line, file your 2025 taxes accurately and early, or keep CRA My Account up to date, because the 2025 return determines what you'll receive starting July 2026.
Number 9, tactical moves you can make right now. An action checklist. Rerun your 2026 tax projection using the new federal income tax brackets. If you expect a raise, bonus, or even job change, check your marginal rates. This will help ensure that you're not hit with any surprises and suddenly you find out later that you're in a higher income tax bracket and possibly paying more taxes. So plan your finances accordingly. Check your TFSA room in your CRA My Account, and if you have room, try to top it up if you can. If you have RRSP room, consider making an RRSP contribution. This will reduce your taxable income, but please don't drain your emergency savings. You want that as high as possible. Prioritize liquidity if you're mortgage stressed. TFSA and high interest savings can be better than forced RRSP contributions if you need flexibility. And speaking of high interest savings accounts, I actually made just recently a great video on this very topic, because you put all this money, sometimes thousands upon thousands of dollars, into one of the big 6 banks' accounts, and you think, oh, my money's working quietly for me in the background, growing. Chances are it's not growing as fast as you think. You could be earning next to nothing on all of your investments. I'll link that video up above here. These tax changes aren't a crisis, but they still matter. I don't know about you, but I always consider taxes kind of a snooze fest. Like if I'm at a party and somebody starts talking to me about taxes, I kind of feel like, oh, that's real interesting. No, I'm just kidding. I know the importance of taxes and what they can do for your financial planning, so I still listen. So yes, in summary, taxes are very important, even though they're boring as heck. If you're interested in whether you should make an RRSP contribution or maybe an extra payment on your house, check out this next video here. Again, here.